Hi everybody, welcome to another video of what's moving the markets. Today we're going to be talking about the earning reports by Alphabet, Amazon, Microsoft, Meta, so the two A's and the two M's, and how to look at them in the context, the backdrop of US elections, how to defensively position your portfolios with the upcoming volatility. So let's get started. Now I've taken out some data over here. This is obviously from the companies but acquired through the Wall Street Journal. And what you see over here is that Amazon is obviously a big spender, right, on this capital expenditure that they're doing for data centers. And if you look at it as a percentage of its revenue, right, it's a very steady amount. So you can see their average and their current spend, and they're not really stepping it up. Whereas Microsoft, Meta, and Alphabet are really stepping that spending up a lot, even though they are far behind Amazon, but nevertheless, they are still stepping it up. However, Amazon continues to retain the biggest share of the cloud market. So that reflected in the market reaction as well. So stocks faced mixed reactions as the reports came out. Amazon stock went up, Microsoft stock went down, right? Meta also didn't perform very well. What the market probably didn't like about Meta is, number one, their subscriber base is slowing down, right? So the market seems to have saturated for them. Number one, obviously. Number two is their metaverse investment hasn't paid off at all. So that's a big loss making investment, right? So Meta not so good. Microsoft also not so good, but still better than Meta in terms of the market future expectations. However, Amazon is a big winner. And another big winner is Google, right? Alphabet, because not only are they benefiting from their cloud business, but their ad revenue seems to be doing very well as well. So we will talk about this. But I also want you to start looking at this in terms of, all right, so what does the market not like about all these tech companies? What they don't like, why Microsoft didn't do that well, is because of the amount of capital expenditure they are doing and they are expected to do going forward. I mean, just look at all of this and look at Microsoft 2024 spending, and they are saying we're going to keep increasing it, right? So this is going to impact their profit margins. And where is all this money flowing into, right? Who are they paying this money to? So you can clearly see from the relative rotation graph that the industrials are benefiting from this, right? Traditional sectors like your industrials, like your materials are benefiting, whereas your technology is lagging. So even though it's the technology companies that are doing the capex, but they are going to face uh, profit pressure on their profit because of these high capital expenditures. And where is that money flowing to? It is flowing into materials and industrials, which we are going to talk about as well shortly. Now, most of you might already know that Google is classified as a communication service because of its huge revenue from advertisement, right? So if you see the sector-wise performance, obviously communication services have done pretty well, and that's because of Alphabet, number one. Number two, financials continue to do well because we are in a high interest rate environment, and looks like that is going to be continuing, right? Because the labor market, if you looked at the jobs data, the economy, US economy hardly added any jobs. So the job market, even though is still pretty strong, but we would have liked to see more jobs being added, right? So the economy is weak, but unemployment is still not that high. It's still at 4.1. So the Fed really is going to be in a difficult position because inflation is remaining stubbornly high. While the job market is pretty good, but it didn't add that many jobs, so they do need to lower the interest rates, but I don't think they're going to lower a lot. So maybe we're looking at 25 basis points, which means it's not going to be a 50 basis point cut, and even the 25 is probably going to be followed by no cut after that. So you're looking at higher interest rates for longer, right, which support bank profitability. So obviously financials have been doing well. This is something we've been talking about, we've been expecting. Alphabet, of course, has come out to be a very interesting winner with the increasing revenue from ad, and also its cloud business doing well. Technology, on the other hand, not doing so well, right? Utilities, again, even though they are really benefiting from the higher demand in electricity from data centers, but they're highly leveraged, right? And because of being highly leveraged, they are rate sensitive. The higher interest rate is starting to kick in with them. And the same thing is happening to real estate as well. So these sectors were weak. And what we see is that there is a rotation into materials, industrials, and healthcare, which we will talk about, right? So this is something we talked about last time as well, that you should position into healthcare because it's defensive, it is recession proof. We talked about some companies as well, and that has played out this week. So if you had actually positioned in the companies that we talked about last time, such as AbbVie, it was up 6% this week. So that would have been good for you because it benefits from, all the old aging population and all the medicines that they need. We have been talking about materials as well, and this sector has been benefiting, as you can see, especially for materials that are linked to the capex spending that the technology companies are having to do to maintain their zero emission targets, and the utility companies behind them again to do the zero emission targets and increasing the energy production. So that is going on within the energy sector. Again, we are benefiting within the renewable energy space, and this is something we have talked about many times before. Now, within the technology sector, you've got your cash flowing to players like Nvidia and AMD, but the price of these stocks is very, very highly overvalued. And this is something that I have been telling you guys about for a long time now, right? And you can see that it has been facing a lot of pressure at that 140 mark. Whereas Intel is still undervalued, and you have to look out for this one depending on how much support it gets from the government and what decisions they take, if they are able to position themselves within the AI space and not just the CPUs but the GPUs as well properly, and benefit from this upcoming spending, then Intel could really perform in terms of price action from its current level. So keep an eye out for that one, right? Communication services is something that we've already talked about, that Alphabet is coming out as a big winner in all of this. Right. Now, again, back to the RRG. So what we are seeing is that industrials is doing well, right? Even you see companies from Canada doing quite well because, of course, they are very well positioned in the industrials and energy and materials space. Even their smaller companies are doing well, which you can see from the TSX Venture. And as always, like we have been discussing for weeks now, that the Nasdaq has been weakening. So there is a clear shift towards traditional sectors like industrials and materials, while tech is facing short-term challenges. Now, within the tech, something that we just discussed, and let me reiterate that Nvidia and AMD and Equinix are overvalued. You need to focus on undervalued opportunities like Intel that we just discussed. Maybe you can look into Digital Realty, Arista Networks, right? Because I mean, if you look at the valuations, there still might be some room left for these companies to play out. Again, not investment advice. You need to do your own due diligence, but this is something that you could look into, right? In terms of the raw materials and renewable energy space, you could look at a lithium producer. You can look at Brookfield Renewable Partners and Livent Corporation, etc. Again, the whole point is look out for undervalued opportunities with exposure to AI, cloud infrastructure, renewable energy, and raw materials instead of going for the highly valued ones, which possibly are already overvalued, right? So what's the conclusion? The conclusion is that you've got a upcoming US election, you've got a Fed meeting which might not cut interest rates that much because of inflationary concerns. So you've got this volatility that is there right now. What do you need to do? You need to position defensively. So how can you do that? Well, you need to strategically position yourself with growth, but at the same time keeping it safe, right? So Microsoft and Google is something we discussed last week as well, and Google has played out very nicely. Microsoft hasn't played out that nicely, but again, I feel it's a good opportunity to get in at lower rates. If there is any pullback, these two companies seem to be very well positioned, right? You can also start looking into some renewable energy and material companies like BEP and ALB. And of course, healthcare is a good option to add to your portfolio because it is recession proof, given that all this upcoming volatility is going to be there, right? So that is it for this week. If you found it useful, please like, share, and subscribe, and leave your comments below. We would love to interact with you via the comments. Thank you for watching, and see you next week.